Hey, this is Chris. Now, July 2021 represents the 12-month anniversary of our Stockspot Sustainable Portfolios being live. So in this video, I'm going to share some of the latest stats and trends in terms of global ESG and sustainable investing, as well as talk about the performance of our portfolios. Now, globally, sustainable investing has only got larger over the last year. In fact, just after the big COVID crisis of 2020, towards the end of the year, the assets tracking ESG and sustainable strategies globally just cracked the $1 trillion US mark, which is an enormous milestone. And in fact, in a single quarter, 100 billion Australian dollars went into sustainable strategies globally. So there's huge inflows into these strategies. What's interesting is where these are coming from geographically. So you might expect, like most areas of asset management, the large amount of money is driven out of the US. In fact, when it comes to sustainable investing, most of the money coming into these strategies, in fact, 86% is actually coming out of Europe, where they seem to be a bit ahead here on sustainable investing and a bit more conscious of it in their investment psyche. The US only accounts for about 14 to 15% of new sustainable investments at the moment. And sadly, Australia is a long way behind, even relative to our asset base. We're only contributing about 0.2% of sustainable investments. But I should say, as we wrote in the recent ETF report, which you can download from the Stockspot website, ETFs tracking sustainable investments are really exploding in growth in Australia at the moment. It's one of the fastest growth areas. So while the growth is off a very low base, the rate of growth is really fast. So how have the Stockspot portfolios performed in this great period of growth for sustainable investing generally around the world? Well, over the last 12 months, they returned between 5.2% and 11.3% between the most conservative and the high growth strategies. This is a good result, particularly that it's well after the market had already started recovering from the big COVID pandemic. How does it compare to the non-sustainable portfolios? Well, actually, for the first year in several years, the non-sustainable portfolios actually performed a little bit better, and that's because the exposures to sectors like mining and oil performed quite well in a world where industrial metal prices were rising. But obviously this isn't the case always, and in the years leading up, the sustainable portfolios actually would have done better because of their exposures to technology and healthcare. And so every year, the relative performance of these sustainable portfolios is really just going to be driven by the relative performance of the underlying sectors. If sectors like healthcare and tech are doing better, you can bet the sustainable portfolios will be doing well, whereas if mining and banking are doing better, the regular index portfolios will be performing better. So what does this mean from a real-world impact perspective? Well, obviously the sustainable portfolios invest in a different universe of companies. And this universe of companies are a lot more sustainable in their endeavors and in their performance and in their business practices. And when you measure those companies relative to the overall market index, the amount of carbon that's been generated over the last 12 months is 18,000 tons less. That equates to about 27,000 more trees being planted, or 6.7 million kilometers less being driven on the roads. So if you've invested in these sustainable portfolios, you can be really proud of the impact that they've had on the world.